Hello and welcome to week 3 of our class. In this week we will be studying how to prepare budgets of all kinds in Chapter 22. In Chapter 23 we will look at how managers use these budgets as a control. To start out, I would like to ask you a question. Why do you think company managers would use budgets? Well, they use them to achieve long and short-term goals, and also to monitor and control costs just like you would in your own household. You might be saving for a new house. A company might be saving for a new building to expand operations. You might be trying to understand and control your costs. A company would also be trying to understand and control their costs. However, in the case of a company, budgeting is more complex than an individual budget. In companies, it is not uncommon to prepare 10 different budgets for a year and have several different departments involved in that process. Some of these budgets would be strategic and some would be operational. Think of strategic as strategy. This is a budget that is prepared over a longer period of time and is prepared with the idea of assisting in meeting long-term goals of the company. In contrast, an operational budget covers a shorter period of time to assist the company with achieving short-term financial goals. Operational budgets are also much more detailed than the strategic budget. Lastly, we will look at a master budget for a company. The master budget includes the operating budget, the capital expenditures budget, and the financial budget. Now, the operating budget includes the sales budget, production budget, direct materials budget, direct labor budget, the manufacturing overhead budget, the cost of goods sold budget, and the selling and administrative budget. The financial budget includes the cash budget, the budgeted income statement, the budgeted balance sheet, and the budgeted statement of cash flows. The capital expenditures budget details the company's plans for acquiring long-term assets, including plant and property. As part of our reading, discussion board, and homework for this week, we will be working extensively with budgets. All of this will be helpful with the completion of your final project, Part 1. And in just a moment, I'm going to show you, we're going to look at that workbook, and we're going to start with the sales budget. And I just want to mention here that the sales budget is typically the most important part of the budgeting process, because you have to have the budgeted sales before you can begin to estimate what your budgeted expenses are going to be. You've got to be able to estimate what you're going to need. So the sales budget is the initial, where we initially begin. Now in Chapter 23, we will look at how company managers use budgets to assist in achieving company goals. Once budgets have been prepared, they can be used as a measurement against the actual results of the company. A difference between the budget and actual result is called a variance, and variances can be favorable or unfavorable. For example, if the actual sales realized for a year is more than the budgeted amount, the company would have a favorable sales variance due to the fact that this increases operating income. Additionally, we will look at we will also look at a standard cost system, which is when a company assigns standards to items such as materials, labor, and overhead. A standard is the expected cost of a raw material or an hour of direct labor. This can again be used to measure against actual results to determine if the company is meeting its goals. Specifically, we will look at direct materials and direct labor variances in this chapter. Again, understanding how these variances are calculated will be very helpful with you in the completion of your final project. So, having said that, let me pull up your student workbook. Here we are. So here is your student workbook where you're going to go in and prepare your budgets, and you see right here in front of us, the very first one is the sales budget. So I'm going to help you go ahead and get July completed here. So in the first cell, it's asking us to input the budgeted number of units. So what we want to do here is we want to jump over to our instructions, and here at the top it gives you a lot of information about paid and approved. It gives you the June budgeted balance sheet and some assumptions here, 1 through 8. I'm going to jump right down here to prepare a sales budget, okay, because this is the part I want to focus on with you right now. So the first thing it's asking us is the budgeted units for July. So as we go through here, we can see that forecasted sales in units are as follows. July is 18,000. So 18,000 units. Remember now, this is not dollars, this is units. So I'm going to put in 18,000 units. Now we also need to know the budgeted unit price. So if I go over here and I read on a little bit more here under the sales budget, I see where the sales price per unit is $18. So I'm going to go right back over here and I'm going to put in that $18. And now I can get my dollar amount of what my budgeted total dollars are. And I can do that simply by multiplying the 18,000 units by the $18. And I see that my budget is $324,000. Okay, so now I'm ready to go on to my production budget. You will want to go ahead and complete August and September, but then you can move on to your production budget. And we'll follow the same process. We'll go over to the instructions. And let's move down to the production budget section here. All right, and let's see what it's asking for first. Then it's asking us for the next month's budgeted sales. So if we're doing July, that tells me that we want to find out what August budgeted sales are, and it'll make a little more sense to you while we're doing that in just a moment. So let's read through here. We see July is 18,000 units, and we see here that August is 22,000 units. So I'm going to come over here and I'm going to put in 22,000 units. Whoop. Okay. All right, the next thing it asks for is percentage of inventory to future sales, okay? So what in the world does that mean? Let me go back over here and see if I can figure that out. If I read a little bit more here on the production budget, I read down here at Assumption 3, company policy calls for a given month's ending finished goods inventory to equal 70% of the next month's expected unit sales. That's why I had to put in next month, because now I'm going to go in and I'm going to calculate 70% of that. Okay, so the ending month inventory is equal to 70% of the next month's inventory. So this is just simply going to be, let me do that. This is just simply going to be 22,000. I can move that, there we go, times 70%. All right, so that's telling me that for July, my budgeted ending inventory should be 15,400 units. Now here I'm going to add my budgeted sales. Remember, in units, I'm going to jump up here. So for the current month, for July, it was 18,000. So I'm going to drop back down here and I'm going to put that 18,000 in. And then to get the required units to be produced, I'm simply going to add the 15,400 and the 18,000. And those are the required units to be produced. All right. So one thing that I have to keep in mind is I've already got some stuff at the end of June. I had some units already made, and I don't want to. So I don't want to remake those again, which I wouldn't. But I don't. If I went with the whole 33,000. Then I'd end up with too much. So I need to take into consideration what I had at June 30th. So I'm going to go back over here, and I believe in my instructions, it tells me that Assumption 2, the June 30th finished goods inventory was 16,800 units. So I'm actually going to subtract that from the 33,400 to get the total amount that I need to actually make or process. So I see that my units to be produced for July are 16,600. So I hope this has been helpful to you. Thank you for listening, and I'll see you next week.